From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Treasury Secretary Janet Yellen tells Congress that banks are safe and sound and the economy is doing well. But can anyone really believe that, given recent bank failures and the latest emergency rescue of First Republic Bank? Also, French drug giant Sanofi says it will cut the price of some of its insulin products in the U.S. by as much as 78%, the latest pharma player to bow to political pressure. But what's the real story on insulin prices? Welcome to Potomac Watch. I'm Kim Strassel, and I'm joined today by colleagues who are going to give you sterling answers to those questions, Alicia Finley and Kate Batchelder Odell. Let's start with the landscape, as it were, out there in bank world. And Thursday's news that a consortium of some of America's biggest banks dumped $30 billion into First Republic in an effort to shore up that San Francisco bank. This comes obviously after the failures of Silicon Valley Bank and Signature Bank. But notably, Alicia, it also comes after First Republic tapped an emergency lending facility at the Fed and tapped a $70 billion liquidity lifeline from JP Morgan over the weekend, and it still wasn't enough. Can you tell us, Alicia, a little bit more about the specific issues that are facing First Republic? How are they the same or different from what we saw at those other two banks? And is this going to stabilize the entity, or are we going to see this to continue rippling through to other banks?
What's interesting is that First Republic has some of the same problems as the other banks when you saw with Signature and Silicon Valley Bank, but also Silvergate, which is known to be more of a crypto-concentrated bank. But some of the issues that it faces are different. So one similarity is it faces duration risk. It piled into kind of long-term, long-dated assets that yielded higher interest rates when interest rates were zero. But now that interest rates are rising, those bonds that it holds or its securities in its portfolio, it has to sell those at a loss if it needs to create liquidity for depositors. So one difference, though, is Silicon Valley Bank was mostly invested in government bonds like treasuries and mortgage-backed securities. Now, these can be very easily liquidated, even though they may actually end up taking a loss. By contrast, most of First Republic's investment portfolio, which was actually only 15% of its assets, were in municipal bonds. Now, these are very thinly traded on the secondary market. Most are held by U.S. households or mutual funds. So what that means is when First Republic has liquidity crunch, it couldn't easily liquidate any assets to meet these redemptions. And the Fed doesn't accept municipal bonds or most municipal bonds as collateral for its new emergency facility. So this seems to explain why it needed the $70 billion liquidity lifeline that JP Morgan and some others offered over the weekend, which $70 billion is huge because that's essentially 1/3 of its assets. But what's troubling, should be sending out, red flags for a lot of investors, is that that still wasn't enough, which suggests that there isn't just a liquidity problem, there may be a solvency problem. I took a look at its investor report and, well, yeah, there are some issues in terms of its very concentrated investment in commercial and residential real estate. And especially in these coastal areas, New York, San Francisco, Boston, and LA, where it does most of its business. And you are seeing the commercial real estate loans are starting to default. Mortgages are starting to default in these areas. And not only that, what's also worrisome is its residential mortgage portfolio, which include a lot of adjustable rate, mortgages, the same kind of mortgages that actually got banks into trouble before the 2008 crisis, right? Adjustable rates, so when the rates start to rise and the mortgage rates have more, doubled, essentially in the last year, all of a sudden these homeowners are on the hook. Some of these are $2 million homes. And they're all of a sudden on the hook. Payments have increased by $1,000 or $2,000. And it's not clear if these have started to go into default and there are foreclosures, but there's a huge risk out there that, we're seeing these layoffs in these coastal areas, especially in Silicon Valley, and that they're going to have to start taking losses on their loan book, which could be why it needed this huge capital infusion.
Yeah, so the bottom line, if I'm hearing you right, is that interest rates strike again. In the case of Silicon Valley Bank, they were in a lot of sovereign debt as interest rates went up. Their bond portfolios became less valuable. Here, you've got a bank that's, as you say, very invested invested in mortgages, loans, real estate. And as interest rates are going up, that's making them more dicey. And the thing that's stunning to me as I watch all this is that nothing here is like an exotic financial instrument, nothing off a balance sheet that was hidden. This is sort of straightforward stuff that they're invested in. And yet no one seems to have considered the possibility that interest rates would skyrocket and that this would have such a huge effect. And apparently, Kate, not even the government. And in fact, if you listen, the administration is currently doing all it can to calm investors and depositors. And that included what was meant to be some soothing testimony by Treasury Secretary Janet Yellen in front of the Senate Finance Committee on Thursday. Let's listen to a clip of her.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
So, Kate, we're getting this sales pitch. According to Yellen and to President Biden, there's nothing to see here. Banks are sound. Economy's fine. By the way, they also mentioned we're going to get inflation in check. And yet, obviously, this comes after the government felt compelled to bail out these other banks, is now racing to stem this First Republic problem. I saw that First Republic took another bath on the stock market again today, despite these efforts. How do you rate what the feds have done so far? And is anybody out there buying the Treasury Secretary's claims, whether that be the market or whether it be people who are banking or whether it be her fellow politicians in D.C.?
Yeah, Kim, I mean, I think the answer is pretty clear from the markets today that investors aren't buying what she's saying. The Dow lost about 418 points, 1.3%. The S&P slid about 1%, a little bit more, and the NASDAQ a little bit less than that at 0.9% on the latest figures. So investors aren't buying this, and it's sort of like that cartoon where the guy's saying this is fine, and there's a bunch of fire behind him because it obviously isn't. And I'd also note, Kim, that I think an apt phrase for this situation is, that's used a lot in national security world, is that there are black swans and pink flamingos. A black swan is something that you don't see coming, a random event that's hard to control, and then there are pink flamingos that are things that everyone should see coming and that are hiding in plain sight. I think this is the latter. It's a pink flamingo. And the question is why regulators didn't see it coming after we have Congress spending excessively and the Fed holding rates at near negative interest for a long time. We knew there would be vulnerabilities as they started to increase rates. And the large question is why regulators missed it. And I don't think we're getting an answer to that question. And I think it may be feeding into why it's hard to credit Yellen on this tour telling everybody that everything is okay.
Yeah, I agree with you, Kate. I think one of the more interesting things that we should be watching, and I saw yesterday that Senator Ted Cruz, his committee in Congress, launching investigations specifically looking into Fed actions here and how these banks, which are supposed to be performing these regular stress tests, et cetera, why this was not flagged sooner. But, Alicia, the other thing that was really striking to me about Yellen's testimony yesterday was that she also made the claim that the government's decision to backstop depositors at SVC and Signature did not qualify as a bailout. And yet there's a lot of suspicion out there that not only was that a bailout, but that politics played a role potentially both in that bailout and in the question of why regulators weren't more engaged here. Let's listen to Senator John Cornyn talk about one aspect of that, the regulators in that committee testimony yesterday.
Some have suggested that this was an example of mismanagement at a time of higher interest rates and higher inflation. Others are saying, where are the regulators? Were they asleep at the wheel? Many have suggested that banking regulators need to focus more on regulating banks, protecting depositors and taxpayers instead of straying off course and examining so-called climate-related risks and other social engineering goals. I think these are all fair points.
Alicia, it strikes me as two things here dealing with politics. First, this question that the senator just posed of oversight and whether or not the San Francisco Fed chief, Mary Daly, and her team were really looking at risk enough or whether they had been sidelined by climate issues. Did they purposely turn a blind eye in particular to the question of SVB, given that it was sort of the darling lender of all of these clean tech and climate initiatives, startups that were out there? I think the other thing, though, is the question of the bailout itself. The loudest demands for all that came from Governor Gavin Newsom in California, Silicon Valley politicians, venture capitalists who, by the way, happen to be big Democratic donors. Was this, in fact, a bailout? Was SVB bailed out for political reasons? Did he get in this situation because of politics, too, and green initiatives and the climate craze?
So I don't think there's any doubt that this is, or question about this being a bailout. There's a reason that the insurance limit for the FDIC is $250,000. That was intended to protect small depositors. And the FDIC, actually, its reserve isn't large enough to cover all the uninsured deposits. So essentially what they're doing is unprecedented. Usually a bank is sold off and then sometimes the uninsured deposits will get covered. But here the government is saying, preemptively that we've got your back. Now, in terms of the bank management and the politics of all this, I'm sure it's hard to doubt that the bank's importance to Silicon Valley in terms of funding, or half of venture capital companies bank with Silicon Valley, and they got very generous loan terms. And the bank was known to be very accommodative in terms of like when startups couldn't make debt payments, they often, extended the maturity of the loans or the credit lines. And a lot of these startups, by the way, are involved in green energy. I think the bank said that there were about 1,500 climate and sustainability startups that it did business with. And so that seems to may have caused the regulators, especially the San Francisco Fed, which is in charge of supervising this bank, and actually was in charge of supervising First Republic and some other banks that now appear to have trouble, may have turned a blind eye, as you say. I mean, it's a focus. If you just go to its website, it's astonishing. It's much more interested in regulating the climate and making sure that the banks are appropriate risk management in terms of managing their climate exposure, which doesn't really present a near-term, immediate, or really material risk to their balance sheets than they are to managing other material financial risks, such as the rising interest rates. And why the Fed bank examiners didn't notice this, or if they did, they didn't say anything. I mean, that's going to be a subject for a congressional investigation. And I think, Ted Cruz on the Commerce Committee has started raising this issue. Interestingly, Pat Toomey, who was the Pennsylvania senator who was the former ranking member on the Banking Committee, he retired this year, but last year he was actually beating the drum on the San Francisco Fed's descent into woke politics, how it seemed way too focused on climate in particular, but also diversity and inclusion. And it seemed to have lost its way and forgotten what it's there to do.
Yeah, a lot of examining yet to be done on the examiners.